Good afternoon and welcome back everyone to another episode of our options education webinar series. My name is Tony Zhang. I'm the chief strategist here at OptionsPlay, and today we're going to be covering the top 3 income strategies for beginners. Now, this is a beginner series, which means that this is an overview of the 3 option strategies. If you want to learn more in terms of details of each one of these strategies, we have already pre-recorded multiple sessions on each one of these individual strategies so that you can learn more. Today, what we want to do is take an overview of these strategies and introduce the concept of how to generate income, specifically consistent income in your portfolio utilizing options. Whether you are brand new to options trading or you've been trading for years, options selling for income should be a pretty large component of how options is utilized in your portfolio. So today what we're going to do is we're going to review the strategies that are most popular with regards to generating income in your portfolio. We'll talk about when to use it, and more importantly, how to actually find trading opportunities using each one of these strategies using OptionsPlay. As a reminder, what we do here every single Thursday with these webinar series is focus on your education and making sure that you have a well-rounded education with regards to investing and trading and anything options related, trying to empower you to trade sustainably and confidently. The two go hand in hand. Being able to consistently grow your account will help you grow your confidence. And income is certainly a core tenet of how you can consistently grow your account in the long run. But before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that I'll be using as example purposes during today's session. So we're going to kick off today by just talking a little bit about what does it take to generate consistent income in your portfolio utilizing options, what you should be focusing on educating yourself, how you should be thinking about approaching options trading in order to generate consistent income in your portfolio. And like I said, we're going to cover the top 3 income strategies. So we're going to first cover actually what I consider as the most underutilized options income strategy, where you should be, where a lot of investors could be using the strategy, but are not using the strategy in their portfolio and missing out on income. I want to focus on that first. Then we'll look at the number 1 most popular income strategy, and then we'll look at the number 1 directional income strategy. So regardless of what your views are on the market, what type of account you have, what type of investor you are, whether you are a short-term investor, long-term investor, we're going to cover pretty much the full gamut in one of these 3 strategies that you'll be able to use in your portfolio. Then we're going to look at best practices for each one to make sure you understand how you should be utilizing these strategies, what you should be looking for in terms of expiration dates, in terms of picking the right strike prices for them so that you can maximize the income and at the same time generate consistent income. And then at the very end, I'll show you how to access trading signals directly on the OptionsPlay platform. That's going to allow you to take what you've learned and instantly implement them in your own portfolio after we finish today's session. And at the very end, I'll open this up for Q&A. But the primary thing that I want you to be able to walk away from today's session is a clear understanding as to what are the most popular option strategies with best practices to generate consistent income for your portfolio. That's what I want you to be able to walk away from today's session with a clear understanding as to how to do each one of these things. So a lot of questions usually that I get around the session of whether this session is recorded, and the answer is absolutely. Both the recording and the slides will be available to you as long as you either have a membership or have a free trial here with us. You can sign up for a free 30-day trial by pointing your phone to that QR code on your screen, and you will also have access to all of the tools that I'll be showing you today to access the trading signals for each one of the 3 trading strategies that we're going to discover on today's session. So make sure that you sign up for that free trial if you are joining us for the first time here at OptionsPlay, or if you want access to the recording and slides by pointing your phone to that QR code, or Philip has graciously pointed us to that link in your chat window that you can see at the bottom of your screen. Now, I see many of you, probably many of you that have joined us before have already chimed into the chat window saying hello and where you're from. If you're joining us for the first time, please feel free to chime into that chat window. Let us know where you're from, where you're joining us from. There are hundreds of you here on this session here today. This is a vibrant community of options traders that have been banded together for the past few years, joined together in pursuit of options trading, options education, and welcome all of you from all around the world. I see Cape Town, I see Germany, I see Sweden, I see obviously plenty from North America, but please feel free to chime in, tell us where you're from, and you can see how many participants are joining from around the world, just like you, trying to dive into the basics here of options trading for today. So let's kick off by talking a little bit about what does it take to generate consistent income in your portfolio utilizing options. So first of all, if you're brand new to options trading, just to understand, when we talk about generating income, what we're talking about is selling options. Options is a contract between a buyer and a seller. What we are talking about is on the selling side. What we're doing is we're selling options in exchange for collecting some income. Now, when you sell an option and collect income, you have to take on some obligations. So this is really important to understand, is what are you collecting in terms of income and what are you taking on in terms of obligations? We're going to talk about both, and you have to make sure you have a nice balance between how much income you're getting versus what obligations are you taking in order to maximize income in your portfolio, where you're rather, I should, instead of saying maximizing, I think balancing is the right word. Balancing the right approach to get the right mixture of income versus the obligations that you're taking on in order to sell an option. So when we talk about consistency with this type of option selling strategy, it really comes down to what we call a systematic strategy, meaning it's a very rule-based approach. And what's good about a rules-based approach is that it's very black and white. There's not much that you have to figure out. There's plenty of back testing. There's plenty of research that's already been done for you. That's what we're going to share with you here today. And you just have to follow the rules. And from my perspective, this makes it a lot easier for a lot of beginners to start because you don't have to figure a lot of things on your own. We have rules that have been set based on years and years of back testing, and our tools actually automate all of these rules that we're going to go over here today, so that you really have a very easy starting point with these types of strategies. Now, it's important at the same time to also understand the best practices, meaning understanding these rules before you start trading them. We're going to go over those best practices. We're going to try to explain them to you. But like I said, you do have to do the systematic work yourself. And we have built tools to help you actually automate most of the tools, most of the steps that we're going to discuss here today. And then what it requires you to do is to either do weekly or monthly maintenance on your positions in order to generate that consistency in terms of income. Now, how frequently you manage your portfolio depends on how often you have to trade. Some of you that look at your portfolios every single week, you probably will want to make adjustments once a week. For those of you that don't have time to trade very often, you might want to stick to maybe monthly expirations and adjust your portfolios once a month. But you have to make sure that you have some type of repetition in terms of the strategy in order to generate that consistent income in your portfolio. Does that make sense, everyone? Please type 1 into the chat window if that makes sense to you. Perfect. Okay, I see a lot of ones. So let's jump into 2 of the strategies that we're going to talk about. The first one we're going to talk about is the most underutilized option strategy. Then we'll talk about the most popular trading strategy. Now, both of these kind of work in conjunction with each other. And some of you may have heard of a strategy called the wheel strategy. The wheel strategy consists of 2 option selling strategies, 2 income generating strategies that work in conjunction with each other to help boost the income in your portfolio. And they specifically are, it's an income generating strategy on stocks that you want to buy and hope that you think are going to appreciate in value in the future. Now, I'm guessing many of you here watching the session here today buy stocks or ETFs in your portfolio. You buy stocks at a certain price, and you're hoping that that stock will rise in value at a later time so that you can sell it at a higher price and realize a profit. So the wheel strategy is actually an income generating strategy that helps you buy stocks that you want to buy at a slightly lower price by generating income to buy the stock. And then as you hold the stock, waiting for it to appreciate, generating an income stream on that stock so that once you then hopefully sell that stock at a later point at a higher price, not only do you realize the difference in terms of capital gains, but you also have an income stream throughout the process of buying and holding onto that portfolio, holding onto that stock until you sell it. So even if you end up selling the stock at a loss, you still have an income stream to offset some of those losses in that underlying investment. And that's really the nature of the wheel strategy. So what we're talking about is a short put to help you enter this, to buy the stock, and then a cover call as you hold on to that stock. Now, I want to start with the most underutilized strategy, because a short put is something that most of you will overlook as an options income generating strategy, even though almost every single one of you that are watching here today have at some point in your portfolio purchased stocks or ETFs in your portfolio. But you may not have thought of short put as an opportunity to acquire those stocks at a discount. So what we're really trying to do here is purchase your stocks and ETF at a discount and then generate income while you're waiting for the capital appreciation of that underlying security that you've purchased. So let's start with talking about what is a cash covered put. This is really where you have cash that you have ready available that you want to buy a stock or ETF with. Instead of placing a limit order to lock in the obligation to buy the stock at a specific price, what you do is you sell a put option at that same price, and using the cash that you would place a limit order as collateral to sell that cash secured put. Now, the difference here is that when you place a limit order, you have to set aside cash. You're taking on the obligation to buy the stock at that specific limit order price, but you don't get paid anything to place a limit order. When you sell a put option at that same price, what you're taking on is the obligation to buy the stock at that price. You have to also set aside cash in order to place that order, but you get paid income as part of selling that cash secured put. So sometimes limit orders get filled, sometimes they don't. Same thing with the selling a cash secured put. Sometimes the cash secured put expires worthless. Sometimes the put gets put to you, which means that you end up owning the stock. But in a limit order, if your limit order doesn't get filled, you have nothing to show for it. You've basically locked away some cash, hoping that you'll be able to buy the stock at a specific price. But if the stock never hits that price, you have to basically cancel that limit order and do something else. Here with the cash secured put, if nothing happens, the stock never reaches that price that you want to purchase it for, at least you have some income to show for it. And most of you probably would be genuinely surprised at how much potential yield that you can generate on your cash, but to acquire that stock, sometimes many times the order of magnitude of how much yield you might think that you'd receive from selling a cash secured put. So what we're doing here is we want to take on the obligations of buying the stock, but instead of just placing a limit order, we want to collect some income to do so. And this is really something that a lot of investors overlook. Now, if let's say that you sell that cash secured put and the stock does get put to you, meaning you now own the stock at that specific price, keep in mind that when you own that stock, you own it not only at that specific price, but because you have income as well, you actually now own the stock at what we consider as a discount, right? The discount is the income that you receive. That's the discount amount that you own the stock at effectively. Now, once you own that stock, what do? You hold on to a stock, right? You own a stock because you believe sometime in the future that stock will be worth more, and you're hoping that sometime in the future you'll be able to sell it for a higher price and realize that profit. Now, that can happen over a few days, that can happen over a few months or a few years. So what happens is that you don't necessarily know what your time horizon is on that holding. So what we're trying to do is help you generate an additional income stream on the stocks that you own in your portfolio. So the challenge, or one of the clarifications that I want to make here with both a short put and a cover call is that because each contract that you enter with selling a put option and selling a cover call is that each contract represents 100 shares, is that you can only do this in stocks that you're ready to trade in 100 share increments. So if let's say you have a $10,000 account, you won't be able to do this on, let's say, Apple stock or Amazon stock, because those 100 shares would cost you, $17,000, $20,000. You have to do this on stocks that you can trade round lots on. Okay, so this is something that you do have to be aware of, and I'll show you kind of how you can screen for lower price stocks if you have a smaller portfolio. But as long as you own 100 shares of any stock, you can sell a call option against it. The call option gives you the same obligations as you placing a limit order to sell the stock at a specific price. Because when you own a stock, you're hoping that it's going to appreciate in value. So what you do is you could potentially place a limit order to say, I want to sell the stock at a specific price sometime in the future. But the problem with the limit order is that that limit order just sits there. You're taking on the obligation, but you don't get paid anything for that obligation. When you sell a cover call, you're going to get paid an income stream, because in exchange for the obligation to sell the stock at a specific price. Now, you're okay selling that stock at a specific price because you own the stock now. You own the stock, and you actually want to sell the stock sometime in the future at a higher price so that you can make that profit. But not only do you do that, you can also collect an income stream while you wait for that to happen. And that could be a few days, like I said, or it could be a few years. So you want to make sure that if it does take a few months or a few years, that you can collect a nice income stream as you wait for that stock to appreciate in value over time, so that you don't just have capital appreciation and dividends to show for it. You have capital appreciation, you have dividends, and you have an additional income stream to show for it. And again, you might be surprised at how much yield you can generate from selling a cover call on the stocks, on ETFs that you hold in your portfolio. We're going to go through some real examples, and like I said, you might be surprised at how much income you can generate. Now, before we move on any further, I just want to make sure conceptually we understand what I'm referring to. These are for stocks and ETFs that you want to own in your portfolio, and what you can utilize is our options to help you acquire those stocks and ETFs at a discount by selling a cash secure put. That's the most underutilized strategies, because most investors don't think of selling a cash secured put as a way to acquire stocks, but you'd be surprised at how much of a discount you could collect on your stock purchases by selling a put option rather than placing a limit order. And then once you are in the stock that you want to own, as you wait for that stock to appreciate in value, selling cover calls helps you generate an additional income stream, sometimes 2, 3, 4 times the dividend yield as you wait for that stock to appreciate in capital. So instead of just earning maybe 2% in dividends on a particular stock, you might add another 8% on top of that in terms of cover call yields, so that as you wait for the stock to appreciate, you're generating a nice cash flow, a nice income stream on the assets that you own in your portfolio. Does that make sense, everyone? Please type 2 into the chat window if that makes sense to you. Perfect. Okay, so let's look at an example here. Let's say you're an equity investor, right? Forget options for 1 second. You're just a straight up stock investor. Let's say you want to buy 100 shares of Apple at $130 and you think that the stock can rally up to $140. So what do? You place a limit order to buy the stock at $130, 100 shares of it, $130, and you wait, right? That's what you do as an equity investor. And if the order gets filled, you are taking on the risk of $130 per share, because that's what you'll effectively own the stock for. And your potential reward is $10 a share. So if you buy it at 130 and it rallies up to 140, you will realize a gain of $10 per share. And you're going to collect dividends and be exposed to Apple until it reaches $140. So if the Apple stock goes up or down, you're exposed to that movement, and you can collect some dividends as you hold on to that stock. Okay, so I think we're all clear as to what a stock investor looks at. So what we're going to look at is, how do you actually acquire the stock at a discount by selling a cash secured put? So here, what I'm going to do is, instead of placing that limit order at $130, I'm going to sell a put option. Let's say I sell a 30-day put option at the same $130 that I would place a limit for. And let's say this collects, in this particular case, $4 worth of income. So I'm going to receive $4 per share or $400 for the full contract in terms of income. And that's income that you receive as soon as you enter the contract. And the contract that you're entering is the obligation to buy the stock at $130. And you have to set aside cash to do so. You need to set aside $13,000 to sell that cash secured put. But what you're going to do is you're going to receive $400 of income. So what you really have to set aside is $12,600 to buy the stock at $130. So you get effectively a $400 discount on your stock purchase. So what that means is that you're obligated to buy the stock at $130. But if you do end up owning the stock, you actually own the stock at an effective price at only $126. So that's a $4 discount. May not seem like a whole lot, but think about if you were able to do that consistently over time, what that would mean for your overall portfolio if you got a discount on the majority of your stock purchases by selling a cash secured put versus a limit order. You're taking on the same obligations, but you're not getting a discount when you place that limit order. So the next time you think about placing a limit order for something that's at least 100 shares or more, think twice and look at, is there an opportunity for me to generate some income and buy the stock at a discount rather than placing that limit order? And what this does is it reduces my overall risk from 130 down to 126, and it increases my potential reward from $10 to $14. I have the same exposure that I have in the underlying security, but now I have less risk and more potential upside. Okay, so let's say 30 days from now, the stock is below that 130 price. That means that I would have the obligation to buy the stock at the effective price at 126. So now I own the stock at 126, and now I'm waiting for that stock to rally. Actually, before we dive into that, let's first talk about this short put, right? I want to kind of make sure everyone's clear on this short put. I apologize. So when we talk about these short puts, you might be thinking to yourself, okay, conceptually, I understand I can buy stocks with a discount if I sell a put option. But when I actually have a stock that I want to do this with, how do I go about doing so? So this is really where we've done an incredible amount of back testing on just which put option should you choose? Because if any of you have ever looked at an options chain, you know that there are sometimes hundreds, if not thousands of options that you can choose from. Expiration dates that are anywhere from 0 days to a few years out. How do you pick an expiration date? And then within each expiration date, there are hundreds of strike prices. How do you pick a strike price? This is really where we've done a lot of research, a lot of back testing, over 20 plus years of back testing to help you understand where you should be picking your expiration dates and strike prices. And like I said, whenever you're selling options, this is a very systematic strategy, meaning you need to have a rules-based approach and follow the same rules day in and day out, which makes it easy for a lot of beginners who are getting started because there's not a lot of figuring out. You just have to follow the rules. And we're trying to not only teach you the rules, but we'll also show you how our tools implement the rules for you automatically. So whenever you're selling a put option, generally speaking, the rule of thumb is to go out roughly 30 days from expiration. So whatever options expiration expires in the 30 days, that's generally a good starting point in terms of options expiration. And then when it comes to strike prices, this is really where you want to pick a put option that's close to the current price of the stock. And we always use a delta-based or a probability-based approach to selecting our strike prices. What that means is that we're selecting a strike price based on the probability that the stock will be below that price and that you will own that stock. So when we talk about a strike price that has a 40 delta, that means a strike price where there's a roughly 40% chance you're going to end up owning the stock at the end of those 30 days. And the general rule of thumb, when you pick this 30-day 40 delta cash secured put strike, you should collect at least 3 times the dividend yield on this cash secured put. Meaning, how much income are you generating? You should generate a minimum of 3 times what the dividend pays on that particular stock. So this is a screen that I found yesterday using the tools I'll be showing you in 1 minute is Intel. Let's say you want to buy Intel. The stock has been trading sideways. Let's say you want to acquire the stock. And what our tool does for you is it screens for securities and it tells you exactly what expiration date and strike price you should be starting your research with if you wanted to sell that cash secured put on that stock, right? So let's say you want to buy Intel and you're thinking to yourself, okay, instead of placing a limit order, let me place a cash secured put. Our tool helps you identify the expiration date and the strike price. And what it does after that is it gives you all of the analytics to help you understand how much income are you collecting, $171 in this particular case. How much do you have to set aside in terms of cash in order to enter the trade? And what is your annualized yield? In this particular case, 4% in terms of the amount that you'll generate over the 30 days. And how much does that come out to be annualized? So just put this into perspective. If you own Intel stock, you are earning 1.16% yield for the entire year. So in 1 year's time, you're going to generate a little over 1% of the stock's value in terms of dividends. By selling a cash secured put, you're going to generate 4% of the stock's value in just 29 days. So in less than 1 month, you're going to generate nearly 4 times the dividend yield in this particular stock. Look, if you annualize that out, that's nearly 65%. So we're talking about a yield perspective, nearly 50 times the yield that you would collect on the dividend itself. And this is really where I say a lot of traders, when I say this is the most underutilized strategy, this is what I mean. Most traders do not realize how much yield they're missing out on by not looking at a cash secured put first, and they just go straight to that limit order because that's easy to understand. But the cash secured put involves a little bit more work, but generates many times a substantial amount of income that gives you a 4% discount on your Intel stock purchase. That's going to help offset some losses if the stock starts to decline. That's going to help purchase the stock at a lower price. And if you end up selling the stock at a profit, it's going to increase your potential profits at the end of the trade. But that's kind of the rule of thumb of selling a cash secured put. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you. Perfect. And I'm going to show you some of the tools that will automate everything that I've taught you here today. But I also want you to understand the rules themselves. Now, let's say you do own the stock. We're going to go back to our Apple example, right? We put in that order to buy the stock at 130. Let's say we now own the stock, and our effective rate that we own that is $126 because we collected $4 of income on that cash secured put. We still have our same price target of $140. So instead of placing a limit order at $140, what I'm going to do is I'm going to sell a cash secured put at the same price. And like I said, when you sell that cash secured put, you're going to collect some income. Let's say in this particular case, by selling that 140 put, I'm going to 140 call option. Let's say I collect $3 worth of income. What this is going to do is it's going to allow me to now generate a consistent income stream of roughly $3 every single month, or maybe a little longer than a month, but generate a consistent income stream where I'm collecting a couple of dollars every month or two, so that as I wait for the stock to appreciate in value over time, that I can collect, a couple of bucks every single month in income as I wait for that to happen. So if, let's say it takes 4 months for the stock to appreciate to my target price, I can collect a couple of bucks every single month, and that's going to generate an income stream in addition to the dividend yield that I'm going to generate. So what that's going to do is it's going to further reduce my overall risk and further increase my potential reward on the trade if and when the stock does rally up to my target price in the future. And I have the same exposure as if I just owned the stock and I didn't sell that covered call. The only thing is that I'm obligating myself to sell the stock at a specific price. And what that means is that if, let's say, one day news comes out and the stock, let's say, rallies up to $150, well, what I've done is I've given up some gains to the upside. And this is really kind of something that I do want to point to investors, because some people will say, oh, I don't like selling covered calls because they don't like to cap my upside. And this is a different type of a framework that you need to start thinking about, because everyone wants, in an ideal world, to buy at the very bottom and sell at the very top. And sometimes when we say, okay, we put in a limit order when we place a limit order at a specific price, we say, oh, we didn't capture this whole move. Well, in reality is that you're never going to be able to buy at the very bottom and sell at the very top. You have to just be comfortable with the specific price at which you're comfortable selling at. And if you do, be happy that you made a profit. you do have to reframe your mind when you think about this type of strategy in this type of strategy. Okay, so let's now talk about selling cover calls. What is the optimal cover call to sell? And this is really where we've done a lot of research as well in terms of selling cover calls and finding the right expiration date and strike price. And it's different in terms of the rules for cover calls than they are for cash secured put. You don't just use the same rules for every single strategy. You have to adapt the strategy to the type of strategy itself. So when we sell cover calls, we generally go out a little further out in time. We go out 45 days in expiration. And in this particular case, what we want to do is we actually want to sell call options that are much further away from the current price of the stock. And again, we're going to take a probability-based approach to selling cover calls. And what we do is we look for strike prices that have roughly a 15 delta, meaning strike prices that have roughly a 15% chance that the stock will be above that price at expiration. So I'm going to use this Intel example here. The stock's currently trading at 44.51. Before, when we were selling put options, we were selling $44 put options. So prices that are very close to the current price that have a very high probability that we will end up owning that stock. But when we sell cover calls, we take a complete opposite philosophy. We take cover calls or strike prices that are relatively far away from the current price, because what we want to do when we own the stock is we want the stock to run, and we want to be able to take profits on that stock when it makes a big run. And we want to capture most of those profits, which is why when we sell cover calls, we want to sell call options that are relatively far away, that relatively low probability that in the next month or over the next 45 days, the stock will rally by that amount. And in exchange, what we want to do is we want to collect at least 2 times the dividend yield on that cover call. And many times you will find that the yield well exceeds 2 times the dividend yield. So we're going to use our Intel example here again. We are earning 1.16% yield on Intel as a stock. Here, what we're doing is we're selling the April 19th $50 cover call. In this particular case, we're going to collect some premium. In this particular case, we're collecting 1.78% in 43 days. So keep that in mind. If you own the stock, you're earning 1%, a little over 1% in 1 year. Here, you're going to earn nearly double that in just 43 days, which annualizes out to 16%. So what that means is that you're earning 13, 14 times the dividend yield by selling cover calls. So even if it only takes you a couple of months for the stock to reach your target price of $50, you're going to generate, in this particular case, substantially more yield from the cover call than you would from the dividend. And you're also going to increase your potential profits on this trade if it does end up reaching that $50 target price. So this tool at OptionsPlay helps you follow these specific rules. I'm going to show you how our tool helps you identify the 45-day 15 delta cover call. I didn't do any of this. I didn't select the April 19th $50 cover call. Our tool did it for me and automates this process of finding the 45-day 15 delta cover calls. And it tells me I have about an 82% probability that I will keep the income and the stock will stay below that $50 strike price. But once in a while, the stock makes a big move. And what you're able to do now is you're actually able to profit on that big move, because now you've sold your stock at a nice profit. The stock's made an outsized move in a particular month. You're actually realizing those capital gains. And throughout, as you wait for that time, you will collect that income stream. Does that make sense, everyone? Please type 4 into the chat window if that makes sense to you. Perfect. Thank you. So let's now jump into the last direct strategy. Now, this is a strategy that has nothing to do with the first 2 that I talked about. The first 2 were for equity investments that you want to hold in your portfolio. Now, not everyone necessarily has long-term positions that you necessarily are looking to enter right now. You might just have a stock that you want to place a short-term trade on. Well, that's really where credit spreads come into play. Credit spreads give you the ability to get a risk profile similar to selling a cash secured put or a covered call, but without the necessary need to own the underlying security, especially if you have a smaller account and you don't have the ability to own 100 shares of a specific stock. selling a credit spread allows you to take an income generating strategy on a directional view that you have on a specific stock. So a credit spread is an income generating strategy for what we consider a mild directional view on a stock or ETF. And this is specifically useful for beginners because a lot of times beginners have trouble timing the markets. Meaning, you may look at this chart, you may not necessarily have a good sense for whether you think the stock is going to make a big move higher or a big move lower. And in order to make profit on buying options, you have to have a big move in one direction or another in order to be profitable. And it's not very often that you necessarily are in a place where you say, I think this stock's going to make a big move. But you're far more often looking at a chart where you can say, well, I think the stock is going to maybe drift a little higher here based on the current trends of the stock. And that's all you need in order to sell a credit spread. You just have a general view on the stock. You think it's going to trend in generally one direction. You don't have to have a specific target price. You don't necessarily have to have a strong view, just a mild view on a specific stock. You can sell a credit spread. It's also a forgiving strategy. It's a strategy that has a higher probability of profit, and that's going to help you build confidence, especially as a beginner. And most importantly, it's a strategy that has limited risk and limited reward. So you know exactly how much money you can potentially make, how much you can potentially lose, and generally speaking, these strategies require a small amount of capital outlay. So you have a small account, you can trade credit spreads. So all of these things lend themselves well for beginners who are starting out with options trading, who have a directional view on the market. You don't want to own the stock, but you still want to be able to generate some income. And that's where credit vertical spreads come into play. So here I'm looking at Palantir here. AI stock recently broke out on earnings and looks like it's breaking out again out of its trading range. So let's say you just think that, I think this can continue in terms of this overall trend. I don't know where it's going to go, but I see that it's an upward trend, and I want to take advantage of that upward trend, but I want to do so by selling some options and generating some income. So when it comes to selling vertical spreads, we've also done a huge amount of back testing. And the general rule of thumb is that you do want to go out roughly 45 days to expiration in terms of choosing a expiration date. And when you're selling a credit spread, you're trading two legs, two options together combined into one strategy that gives you limited risk and limited reward. So what you always want to do is you want to sell an at-the-money call or put. And whether you do calls or puts depends on whether you are overall bullish on the stock or you're bearish on the stock. And for those of you that want to learn more about this specific strategy, I've recorded a specific session just on helping you dive into credit spreads so that you can learn more about this. But what you're doing is you're selling an at-the-money call. In this particular case, when the stock is trading at $26, what we're selling is a $26 put option. So very similar to what we're doing before, a cash secured put. But maybe you don't have enough cash to sell 100 shares of buy 100 shares of Palantir. What you can do is you can buy a lower put. In this particular case, we're buying a put option at about 25 delta. So a put option that has a 25% chance the stock will be below that price, which is $23. So what we're doing is we're selling the $26 put and we're buying the $23 put. And when you combine the two together, you end up with a strategy that has limited risk and limited reward. In this particular case, your maximum reward is $120. Your maximum risk is $180. So in this particular case, the only thing you need to place this trade is $180 per contract. So like I said, small capital outlay. To buy 100 shares of Palantir, you need $2,600. Here, you only need $180 to take a similar risk profile with limited risk and the same type of income potential on that specific stock. And the rule of thumb here with credit spreads is that you must collect at least 1/3 of the distance between the two strike prices. I'll walk you through that. We're selling the $26 put option and we're buying the $23 put option. The distance between those two strike prices is $3. Now, any single vertical spread, whether you're trading a debit spread or a credit spread, is the difference between the strike prices is what matters, because that's the total amount that's at play. And whatever you collect in income out of those $3, the rest of that is going to be your total risk, which is why if you look at the $120 that you can potentially make, if you add $180 to it, that's a total of $300. because the distance between the two strike prices is $3 multiplied by 100 shares is $300. That's what we're playing with. And what you are collecting in this particular case is $120. That's your maximum potential income. And the rest of that $3 is going to be your risk. So in this particular example, whenever we're selling credit spreads, we want to make sure that what we are collecting is at least 1/3 of the vertical width. So if you're collecting something that's $3, if you're trading a credit spread that's $3 wide, you must make sure that the income portion of it is at least $100. Because this income is $120, that means I'm getting an optimal credit spread. I'm actually generating more income than I need, or rather that I want to earn on this particular trade. And what that does is it increases my potential return and decreases my overall risk. So it's a small capital outlay, giving me a risk profile similar to selling a cash secured put, but I don't have to take on the amount of capital is required to sell a cash secured put. I don't have to take the risk on to selling a cash secured put, and I'm getting a similar risk profile. And you can do this for bullish strategies, and you can also do this for bearish strategies. So if, let's say, you believe Palantir is overpriced, you think the stock is going to pull back, it's trading at a pretty ridiculous PE, you think the stock's going to pull back? Well, you can sell a bearish credit spread and do the same thing. But the same rules apply. You have to collect at least 1/3 of the vertical width when it comes to selling a cash secured a credit spread. So last part of a credit spread, because this is a directional strategy, you want to make sure not only do you align the rules for selling a credit spread, but you also want to try to time the markets. So here's a stock that's been in the uptrend for quite some time. In theory, you could have entered a credit spread at almost any point throughout this year, and you would have been largely profitable. But timing would have helped you be profitable faster. Meaning, even if you were terrible at timing and you entered a credit spread at this point, which just kind of looks like where we are right now, right? Where we are right now looks something like this. The stock makes a big move, it's consolidated, and it's starting to break out. And let's say you enter that credit spread right here. You would have made some profits early on very quickly for a couple of days, but very quickly you would have seen some of those profits evaporate, actually turn into a bit of a loss. But eventually, if you held on to it, this strategy would have been profitable. You would have had to sit through a bit of pain, right? You would have had some small gains, not enough to quite take profits. It turned back into a loss and then turned back into a profit, which is always difficult to sit through as a trader. It's hard to have the wherewithal to sit through that from an emotional perspective, which is why when you think about selling credit spreads or entering any type of trade, when you've identified a trend, it's many times better to wait for a pullback in the trend to enter that trade from a timing perspective, because if you were patient and waited for that pullback, you would have been profitable within just a few trading sessions. You probably would have gotten to a point where you would have said, okay, I've made enough profits, I'm going to take profits and get out of the trade. So you would have had a very similar end result, but you didn't have to sit through all that pain, and you certainly didn't have to wait 3-4 weeks to get to that profitable point. You could have maybe done it in just a week's time. So this is really where, when you're trading from a directional perspective, not only do you have to think about what are the optimal points to get into a trade from an options perspective, but also timing. And that's really what's tricky, or rather more complex with trading strategies. But that's really where, from our platform, we help you do all three things and automate everything I just taught you here today. When you look at your short put ideas on our platform, so under the ideas section of OptionsPlay, you will find places where you can look at optimal short puts, optimal cover calls, and optimal credit spreads. So under short puts, what you're basically doing, or what you want to do, is you want to merge our report with stocks that are in your watch list. So what we do is we basically take our short put report, look at those stocks in your watch list, and what we do is we only return the short put opportunities for stocks in your watch list. And what we do is we sort it based on the income yield. So that's how I found the Intel trade that I showed you here before. And as you can see, you can look at your watch list and say, which stocks, if I were to buy today, would I generate the most amount of a discount on that stock purchase? And you might want to look at your stock and say, your list and say, okay, I'm really bullish on Boeing because it's recently pulled back. I think it's at a good buying point. Netflix has really been killing it recently, so maybe I want to consider buying the stock at a lower price. And maybe both of those stocks are out of your reach because of the stock price. So maybe you might looking at lower price stocks like Intel, Baker Hughes, OKE. So these are the type of stocks. So you can really use this watch list to quickly sort through ideas and find where can I buy stocks at a discount and know exactly how much of a discount I can purchase. And once you own that stock in your portfolio, that's when you can turn to the cover call report. So if let's say you own Intel in your portfolio, it'll tell you exactly what strike price you can sell, how much yield you can generate on that specific stock, and know down the line. So let's say you also own Schlumberger. If you sold a 55 strike, you can earn another 10% yield on the stock that you own. If you own Disney, if you sold a 120 strike, you can generate another 7% yield on that stock. So this helps you quickly identify which stocks in your portfolio you can now generate additional income in your portfolio. And lastly, credit spreads. What we do is we look for credit spreads that are liquid, that generate at least 1/3 of the vertical width, and have recently pulled back that give you that opportunity to potentially enter that trade. And we give it to you all in a listing that you can easily sort. And this is all available to you on your OptionsPlay platform. So like I said, it's under the idea section. You can have the pull down menu where you can select from cover calls, credit spreads, or cash secured puts. You just select one and it'll pull in the new cover call report. Let's start with short puts actually for 1 second. And what I want to show you is this button right here will basically merge the 138 opportunities with the stocks that are in your watch list. Because generally speaking, you might want to, you're interested in the stocks that are in your watch list. You click on that. And let's say Fifth Third Bancorp, currently trading at $36. Maybe you're interested in buying the stock. If you sold a $36 put option, you can generate $145 worth of income. That comes out to be 4.2% income in 43 days. Keep that in mind. If you own the stock, you're generating a nice 3.77% yield, but that's 3.77% over 1 year. Here, you're generating more than that. You're generating 4.2% in just 43 days. That annualizes out to 41%. That's a yield that's more than 10 times the dividend yield. So like I said, most investors are quite surprised at how much income they can generate by selling a cash secured put versus just outright placing that limit order. And you're giving up this yield by not using that cash secured put. And our platform is designed to help you identify these opportunities and help you implement them based on the rules that I taught you, because our scans already apply these best practices. We're going out 30 days to expiration. We're finding the strike prices that are roughly 40 deltas on these cash secured puts. So you just have to look at, you don't have to pull up the options chain. You don't have to figure out what expiration date, what strike price. We tell you how much yield you can generate, and you can look at the yield, compare it to the dividend yield, and decide whether this is one that you want to buy or not. So if you like Intel, you think there's an opportunity on the stock that's recently pulled back, well, you can get about a 3.5% discount buying Intel using a cash secured put rather than a cover call. Okay. And then once you're in the stock that you own, then you can pull up your cover call screener. So the same thing, you can look at stocks that are in your portfolio and say, okay, here are the stocks in my portfolio. I don't have to look at all the other cover call opportunities because those don't matter to me. I only care about the stocks that I own in my portfolio. So you can click on this button and it pulls in the stocks that are in your portfolio. And you can say, okay, I own Bank of America here. Now, Bank of America pays a decent dividend, right? So let's take a look at Bank of America. It pays a 2.6% dividend. But if I own the stock, I can sell the $39 cover call, and I can, in this particular case, generate another 0.85% in the next 43 days, which comes out to an annualized yield of 7.44%, which, if you think about it, comparing it to the dividend yield, is nearly 3 times the dividend yield by selling a cover call. So what I'm doing is I'm basically turning my 2.65% yield on my Bank of America stock into roughly a 10% yielding stock by adding cover calls to it. And this is really kind of what I look at to determine whether it makes sense for me to sell cover calls. And looking at Apple here, Apple's a good example here. Apple only yields 4% on the cover call. But keep in mind, Apple only pays me 0.57%. So what I'm turning is a 0.57% yielding stock to about a 5% yielding stock by adding covered calls. This is the worst performing covered call that I can find in my portfolio. Freeport McMoran earns an 8% yield on a stock. Freeport McMoran pays 80 basis points. I can turn this into nearly a 10% yield on my cover calls by adding cover calls to that stock. So increasing my yield by magnitude of 10 times by selling this by selling cover calls. And what this tool does is it automates all of the work for you. It selects the expiration date, the strike prices based on the best practices that I just taught you, so that you don't have to do any of that work. You just have to pull up the options to play tool. Once you have your watch list and your portfolio set up, everything is done in just a couple of clicks, and you turn hours of research down to just a few minutes worth of research. And this is really how you can start powering hundreds, if not thousands of dollars of income in your portfolio every single month through the tools that I've just showed you here today. And that should easily offset the monthly cost of your OptionsPlay subscription by just using these two tools alone, the cover calls and cash secured puts for the stocks that you own in your portfolio or the stocks that you are looking to acquire in your portfolio. And lastly, for those of you that want to play directional views, you want to play some opportunities, that's really where you can turn to the credit spread report. Let's look at a trade that we probably are all familiar with, Block. Very popular stock a few years ago. Hasn't been doing so well recently, but on earnings seems that it's popped, trending higher here. But as you can see on the trend higher here, it's recently pulled back, and that's your buying opportunity here. So what we've done is we're selling the $77.5 by $70 put option. That's a $7.5 wide credit spread. Remember, I want to collect at least 1/3 of that, which is $2.50. Here, I'm collecting $2.88 in this particular trade. So what I've identified is a stock that's very liquid, so I know that I can trade options in it. I've identified a credit spread that collects at least 1/3 of the vertical width. So that means that I'm collecting a fair amount of income on this. And I've made sure that I've been patient on the directional view. I'm not waiting just for a big move to the upside. I'm being patient, waiting for that pullback here, and then hoping that we get a better shot at placing this trade and timing this correctly. So our tool basically does all of that work for you and gives you opportunities that you can pull the trigger on immediately using this tool, using all of the process that I've taught you. So even if you're not interested in trading directional trades and you're just looking at cover calls and cash secured puts, this tool should be able to generate at least a few $100s, if not a few $1,000s worth of income for you every single month by using the tools, by automating the process that I taught you here. But if you are a trader and you want to sell some credit spreads, this is also an opportunity for you to generate potentially a few $100s worth of income, even on a small portfolio. Again, offsetting the cost for your membership here at OptionsPlay. So hopefully this gives you a clear understanding as to not only the top, or rather the most popular income strategies that you can utilize for options in your portfolio, but more importantly, the tools that we have here at OptionsPlay that actually implement these strategies for you, so that you don't have to do any of the manual work of pulling in an options chain, figuring out what expiration, what strike price, how to manage it. This does it all for you as part of your subscription here at OptionsPlay. And like I said, this is designed to try to make your life as easy as possible. We built it for ourselves as options traders to make our lives easier. And now we are here to hopefully show you how you can make your life a lot easier and how you can generate a few hundred, if not a few $1,000s worth of income in your portfolio. So before we jump into Q&A, I just want to remind you, if you want access to the OptionsPlay tool and you're joining us for the first time, you can sign up for a free 30-day trial to the tools that I just showed you here today. You're also going to get the recording with the slides as part of your membership, so that you can review what you've learned here today. You can then dive into the cover call, the cash secure put, and the credit spread webinars that we have separately if you want to learn more about each one of those strategies, so that you can dive deeper before you execute those trades in your portfolio. But you will have access to everything by simply signing up for that free 30-day trial. You can do so in just a few seconds by pointing your phone into that QR code or using the link here on your screen, optionsplay.com/sign up. And that will give you access to everything. With that, let's open this up for Q&A. I don't have too many minutes for Q&A, but let's try to answer a few questions that you have. There's a Q&A window at the bottom of your screen. Please type your questions in the Q&A window, and I will try to answer as many questions as possible. Carl, we upload all of these things to YouTube. So we don't see a lot of audio or visual or audio or video problems on YouTube. So maybe try to see if there's anything you can do by switching browsers. But usually YouTube's pretty reliable on seeing the replays. I've been for a while, and as a beginner refresher, would you suggest index, ETF, or stocks? Is it best for 45 days for full timers? 45 days are definitely suitable for full timers. I definitely think 45 days is suitable for full timers. Index options, you're not going to collect much income on that. And you're not going to collect much income on ETF options either. Because they've diversified away a lot of the risk, it also means that you get a lot less income. So generally speaking, the best strategies for this type of the best underlyings for these types of strategies are individual stocks. Why can't you sell a naked call? You can sell a naked call, but you're taking on truly unlimited risk. Think about GameStop. If you sold a naked call on GameStop at, let's say, $50 when it was trading at $40 and the stock rockets to, $300, you're taking on tens of thousands of dollars worth of risk in that scenario. Unlikely, but generally speaking, as a strategist, I don't think it makes sense for you to put yourself in that position. I've got on a credit spread approaching 94% of profit. I don't mind getting the sign, but more likely want to close it out. Most of the time I can see the bid ask will only have an ask price and no bid. So, Grace, if something is 94% in the profit for a credit spread, then your assignment risk is virtually zero, because that means that something is so far out of the money that, it'll just expire worthless. So in that particular case, if you don't see a good bid ask on that trade, just let it expire worthless instead of closing it out. When you sell a cover call for 45 days, what's the best time to roll if we are experiencing the risk of getting it in the money? Should we consider rolling before 21 days? Great question. If you're selling a cover call and it's in the money now and you think the stock can go higher and you want to roll it, wait for the last 2 weeks before you roll. Don't do it early because you're locking in that loss. Are you selling the put in the money? No, we're selling the put just out of the money. We want to sell a put that's just out of the money, about a 40% probability that you actually end up owning the stock, which means that you're going to have a nice juicy income and a pretty high probability that you're going to end up owning that stock. Hi, Tony. Using the wheel strategy, how would you have managed a stock like Meta that had a large move in price well above your strike price? Particularly if you want to get back into Meta, what strike price would you choose to sell your put? Sometimes you just will never, you will just be chasing your tail on a short put. Well, what you do, Michelle, is that what you do is you simply, once that put option expires worthless, you sell another put. And if that put expires worthless, you sell another put. And, worst case scenario, you never own the stock. But if you are generating 20-30% yield on the cash that you are setting aside to potentially buy the stock, and on a stock like Meta, let's take a quick look here. Let's say you want to take a look at selling a cash secured put on Meta. Let's look at selling a cash secured put on Meta. Here, look at Meta. You can generate a roughly 37% yield, right? And even if we go out to 30 days to expiration, right? And we're going to use Meta's at 512. Let's say we sell a $500 put. That's about a 60% probability of that expiring worthless, or about a 40 delta, right? You're generating 32% yield on the cash that you set aside to buy Meta. So even if you just constantly chase Meta and you never own the stock, you're earning 32% yield on your cash. So if throughout the last year you kept selling puts and you never got assigned, right? Every single time you're putting away this $48,000 roughly to buy this 100 shares, you're going to keep collecting $1,000 every single month. That annualizes out to 32% return over the whole year. That's not a bad result, even though you didn't capture this big move, right? You still have 32% yield to show for it. That's really not a bad result. So, that's kind of in your scenario, worst case scenario is that you're earning 32% yield. You're just not getting the 100% return on the stock itself. What about stocks that don't pay a dividend like Berkshire B? As you do enough of these, you'll start to get a sense for how much yield you generally are going to collect. So even if you're on a stock that doesn't pay dividends, you'll start to get a sense for what's a reasonable amount of income and what's not. If your goal is only to collect monthly income stream, what's wrong with selling in the money cover calls to get assigned? Um, you just have no upside. If you're going to sell an in the money cover call, you might as well sell a in the money short put. Um, there's really no upside to selling an in the money cover call because you have no upside. Would you consider selling one cash secure put with selling a credit spread call? Would you consider selling? Yeah, you could do that because that's kind of like selling a strangle, but you don't have unlimited risk of the upside. Don, if you're considering that, I would say congratulations to you because it sounds like you've graduated from my beginner buying versus selling options masterclass because you're really taking on a true understanding of how to take individual strategies and combine them into something that makes sense for you, right? So Don's saying, would I sell a cash secured put and a call credit spread to the upside? And what he's doing is he's basically selling a a strangle, and then capping his unlimited risk to the upside, which is really smart because the biggest risk in selling a strangle is that unlimited risk to the upside. So Don, if let's say you feel that the stock is fairly neutral, you think that the implied volatility is very high, you're looking at the IV rank and it's on a relatively high IV rank, and you're saying to yourself, this is a scenario where I would sell a strangle, then yes, selling a cash secured put and selling a call credit spread makes sense in that particular example. For covered calls, should I have capital gains just to be safe? Great question. I think Garrett's asking, do you only sell cover calls on stocks that you are in the green on that underlying stock? I don't necessarily believe in that, Garrett. I believe that even if a stock that you're losing money on is an opportunity to generate some income because it's the opportunity cost of the capital that you're tying up in that underlying security, right? I do think that stocks that are underperforming, you should also not only consider selling cover calls on it, but you should also consider, should I just sell the investment, right? Because should I, instead of keeping my capital in a stock that's not performing, should I just sell that stock and maybe reallocate that cash to something that is performing? That is always something that you should be asking yourself in addition to, should I sell cover calls? But I don't necessarily just subscribe to only selling cover calls and stocks that you have capital gains on. Is there a way to show the list in a dollar amount, a high dollar versus low dollar? Yeah, so you can sort this. So for example, you can sort this based on premium, right? And that's going to show you low price stocks first versus high price stocks down the line. So yeah, you can do that. There's quite a few different ways that you can rank it, but premium is one way to rank by stock price. Yield is obviously based on how much yield you collect. All right, I'm going to do one or two more questions. Does OptionsPlay help with a strategy to manage the losing credit spread? Yeah, so the portfolio tool helps you track your open positions. You can either use the tool to track your open positions like this. So for example, we have a credit spread we don't have a credit spread right now in the daily play portfolio, but you can see your overall positions in your portfolio using the portfolio tool. And the percentage P&L is going to be really helpful in giving you an understanding as to when you want to take profits or cut losses on your credit spreads. Let's do one more question. With bull put spreads, credit spreads, if you get the directional view wrong and the stock falls substantially below your lower strike, is it advisable to only close the short put and let the long put run to expiration? Very good question. I would say that in most cases, the answer is no. If you find yourself you feel that you're pretty confident in your ways in your ability to navigate the markets from looking at a chart, you feel pretty confident in your overall thesis, you can do that. You run the risk that you do run the risk that the stock will then rally back up, and you also lose money on the long put as well. So you actually end up losing more money than you originally entered the bull put spread with. The bull put spread When you enter the trade, you know exactly how much money you can lose. No matter what happens, you can't lose more than that, right? Especially if you hold it to expiration and close it by expiration. Now, if you do what you do, you are exposing yourself now to more risk. So what you're doing is you're basically saying, I want the opportunity to make my money back, but I'm going to take more risk in order to do so. And I'm generally not a big fan of taking on more risk to hope to make your money back, because that can always blow up in your face. So the short answer to your question is yes, you can do that. I don't necessarily recommend most people to do that. Okay. Okay, that covers enough for what I want to share with you here today. I hope that this was helpful in giving you an overview of the 3 most popular option income generating strategies. We went through a lot here today. I had to race through it to get to everything in just slightly over 1 hour, and I got it in there for just in under 1 hour. But that's why we have it recorded. That's why we have the slides, so that you can follow along at your own pace. And if you have the OptionsPlay tool, these things are all here for you to play with under the idea section. The cover calls, the credit spread, the short puts. These 3 reports should be some of the most powerful tools in your portfolio to help you generate hopefully hundreds, if not thousands of dollars of income in your portfolio. And I hope that for those of you that subscribe to OptionsPlay, those 3 tools alone provide enough value to offset the cost of your membership for your subscription. With that, thank you so much. Have a great trading day, and I'll see you guys here next Thursday.